Hi, this week we have three very interesting webinars for you. First, on the 31st January at 4:30 pm, we have a webinar about the role of fixed income in asset allocation in 2025. In this webinar, we will discuss about the evolving landscape of fixed income in 2025, exploring key themes such as navigating shifting interest rate environments, optimizing portfolio diversification, and identifying attractive opportunities within various fixed income asset classes. The next webinar, titled Invest Smart in Volatile Times, will be at 5:30 pm. This webinar will cover strategies for managing risk, optimizing returns, and building a resilient portfolio in volatile times. And on 1st February at 1:30 pm, we have a webinar titled Multi-Asset Strategy for a Volatile Year. In this webinar, we will discuss how a multi-asset strategy can help you balance risk and reward, ensure steady growth, and protect your portfolio during volatility. If you would like to join us for any of these webinars, please register in the link given below.
It's a nice cold January morning. We're back here and we're going to be talking straight. And with us is somebody else who's also back here, Subra. Good morning, Subra.
Good morning.
So, after so many very good years for equity investing, how are you seeing 2025?
I seriously think if you break the market into three portions, large cap, small cap, and mid cap, all three will require different strategies. The mid cap market is very small. The number of companies which are available to you is very small. So, creating very different mid cap portfolio is not going to be very easy. So, all mid cap will be more or less same. Whereas in small cap, you have a range of maybe 1,000+ companies from which you can invest. All of them may not give you enough growth or enough value of shares, in the sense that you may not have enough volume for a mutual fund. But I think you have to deal with each of them separately. I think mid cap may be fully valued, but you'll never be able to say that about small cap because the range is too big. So there will be portions of small cap which are overvalued, some are fairly valued, and some are not discovered at all. Now, if you take a Reliance, there must be 100 analysts at least tracking it. If you take a company which is based in Coimbatore, which is not even heard of in Bombay, it may not have even one analyst. Till one broker or somebody picks up and talks about it. So I think a dynamic fund manager has lot of choice in small cap. So I would look at each one of them separately. I wouldn't say everything is overvalued or everything is undervalued. It will be a stock picker's market. So small cap you will be able to do some stock picking. Of course, you've created value in the market over the last 3-4 years at 22%. Your expectation management has to be better. What happens in equity returns is sometimes you get the returns completely upfront or sometimes completely at the end. We have no clue what will happen. So I think a lot of equity returns have already come upfront. So we have to manage our expectation and client expectation. But yes, I do think, I will not say the easy money has been made. Yes, there will be some things which you can discover, whether you can sit through with some more volatility, that is what you would see. Is this a mouth-watering market? No. Will you go back in 2028 and say, oh my God, I should have invested in 2024, 2025? No. It's not a runaway going up market. So staying out of the market will not hurt you. Staying out of the market is also a bad habit because you may not get back into the market when you should. So if you are earning well and your income is not stopping, continue your SIPs even in small and mid cap. But do vary that your expectation should be lower. You're accumulating units at a high price, and be careful about the portfolio in which you are investing. Some fund managers may not be careful enough, but stick to small cap. You should not do too badly, but have a 5, 7, 10 year kind of a view. That's what will help.
One thing you noticed in this conversation so far, you mentioned three buckets: But you've only spoken about two.
Yeah. So
You didn't speak about large cap yet.
So large cap has not performed well for a long time, which means there's a good scope that large cap will perform. I mean, if you take HDFC Limited Bank or Reliance, they have not really done much over the last 1.5, 2 years, maybe even 3 years. Kotak Bank and HDFC Bank and all have not done well. They have to do well. Ultimately, the insurance arm will do well, the AMC will do well, banking is doing well. Banks are in very good shape. Banks are today not taking any risk. The risk has shifted to private equity and mutual funds. Very sad, but it's a mutual fund investor who's taking more risks because of the private placements, etc. Equity, most entrepreneurs are today funding with more equity because they're getting it at a huge premium. So a lot of risk has already shifted. So if you ask me, large cap should do well. But look at the PE and all that. But I think large cap over a 3-4 year is a better bet than mid cap. Small cap, you could come out with any number because there is more to be discovered.
You mentioned that the mutual fund investor is taking more risk because the funds are participating in IPOs.
Correct.
Or
And
pre-IPO.
Yeah, IPO.
Or as
IPO,
anchor
yeah.
investors. But there's still a wider segment of people, a cross section of people who are also participating along with the mutual funds. It's not as if only the mutual funds are participating. The HNIs are participating very heavily. Retail is participating very heavily. You look at the subscription of SMEs.
Yeah.
You're clearly seeing that people are willing to give equity to anybody, literally.
Correct.
In the hope that in 7 days, they could be seeing money. Do you think this 7-day IPO cycle has distorted our behavior at a very fundamental level?
Actually, if you ask me, this is not a great example, but you know what happens in dementia? Your long-term memory remains intact, your short-term memory is lost. So long-term memory is the 1970s and 80s memory where CCI was controlling the price. So you got a Colgate at 25 which opened at 90. People remember that. But people forget that in Zomato or any of those new issues, Reliance Power, from there, see, okay, there are two parts. One is when Reliance Power and all came, they said companies should be making profits or things like that. It could not be making losses. So maybe it was a small company trying to go big. Afterwards, they changed it even more, saying you can be making losses as long as some institutional investors are taking a stake. But that is not true. In these companies, you will not make money because you are not an investor. You are providing exit to the HNI or the VC or the PE. You are not going to make money. So if you take a simple rule, any OFS is not somewhere where you are going to make too much money. In an IPO, you may make money, but there are just too many frauds which are coming as IPOs. So I think people, if they made money, they're lucky. They should stay away because there are just too many people coming into the market. So there they will lose money. And it's unbelievable when you deal with fund managers, you realize they have the same problems which you have. They also have FOMO.
I'm going to take you on this because the general view today is that people like you and me who give this view are old, out of the market, not in touch with the current reality. What is your reaction to that?
Yeah, that's fine. I'll as long as I make money, I'll stick with any reputation risk.
When was the last time you applied in an IPO?
I don't. Simply because you get such a small, minuscule share. You put 2 lakhs because above that you go into the HNI category. How many shares you end up getting? If it's a real good share, I want a much bigger quantity than what I will get in
So
an IPO. I won't apply in an IPO. But you cannot stop the fund manager from applying in an IPO, especially a fund manager with say 3,000-4,000 crores, because he thinks he is going to get a listing pop and that is going to improve his earning. I don't think the fund manager with 20,000 crores or even 50,000 crores, he is not interested in IPO, but he does pre-placement things saying.
But don't you think a fund manager and retail investor are in the same mindset?
Yeah.
They're in the
Ultimately, end of the day, there is a human being sitting there who cannot be controlled even by the CIO because he says this is my style. You can't really do much.
So how do you look at the criticism by the HNIs who also participate very heavily in IPO with leverage against fund managers? And how do you think that, how do you position the criticism of the retail investor that, oh, fund manager went and bought and he made a loss. Well, this guy is also doing the same thing. So what is the justification of all these three categories of people in the stances they take? Because they're all eventually doing the same thing.
No, but see, the fund manager also has FOMO, and the fund manager is controlled by the CIO saying you can do, but do with a small portion, 1% of the AUM or something like that. But they will take risk because when he does not apply and it opens at a huge premium, like say DMart and all, he feels that hey, I could have applied. But it also happens that in Paytm he loses money. So both these things will happen. So you have to decide on how much to put, where to put. Very difficult as a fund manager. Because when a fund manager does well with 500 crores, we pump him with 5,000 crores. He does not have the necessary skills. What will we do? He will apply in IPOs.
Forget skill. I think he may not even have opportunity to deploy if he gets more capital. See, the time you get more capital.
Correct.
You don't have a place to deploy. It's a problem.
Correct.
That's why you go into subpar or subprime companies.
Correct.
While on the subject of DMart, you mentioned DMart. I'm not going to ask you about DMart per se, but I'm going to ask you about the type of IPO DMart was, where they barely sold 10%, in which a lot was reserved for institutional investors and then retail. So basically, anybody who wanted to get a opportunity to buy DMart didn't have it in the IPO.
Correct.
So there was a listing pop. And the listing pop, again, those who already owned it in the IPO bought more, I presume. Quite a few people
must have happened.
Bought a lot more. And then there was no float.
True.
Subsequently, from that time to now, there's only one person who can supply paper.
Correct.
The promoter.
Absolutely.
So, even whenever the promoter supplies the paper, broadly people are buying it, and again, the float is reasonably controlled. I would even take responsibility and say the float is cornered.
Correct.
Now, this model of IPO is not something DMart has brought to the market. You can't blame DMart.
Correct.
Personally, I think that this model of IPO is distorting price discovery and discovery evaluation of businesses very, very badly. In the case of DMart, there was nobody desperate to sell. Promoter is also not desperate to sell. He sells when he wants to. And it's de-risky. But there are companies where there are sellers waiting. Private equity, venture capitalists, pre-IPO guys, anchor investors. So these guys first go in, get a rent in a good idea, and then they take the rent out.
True.
And then after they go out, the valuation comes down. Good example I can give you. IndiaMart, Delivery, companies which, opened at a very high price, but now are not really there. What is your thought on this IPO process where you are controlling the float without realizing it? And you're actually controlling the float, the structure of the IPO itself.
See, there are
in the name of protecting the small investor, retail investor. You are giving less to the retail investor, making institutional investors take more of the risk. See, the control is at the allocation of capital to category. So, through allocation of capital category, you are thinking you are controlling the risk. But actually, the risk is going up. Any thoughts on this?
Look at it this way, the retail guy should participate only in a widely held company where price discovery makes sense.
Not happening. No,
I'm saying in a Reliance or HDFC, one guy can't corner, one guy can't really, even in companies like Siemens and all, the supply is extremely restricted. The owner is not going to sell. People are happy with the returns. They are not selling.
But when Siemens comes and sells, people are shocked. No?
People are shocked. People say, why are you selling? But when I get a PE of 120 in India and I get a PE of 6 in Germany or in UK or something, obviously they will sell. So you have to expect that. But Shyam, having said that, over last say 40-50 years, coming down for HUL means to a PE of 50, going up means to a PE of 70. So you can't go only by PE because PE is controlled by the supply also. So if you ask me, saying 76% should be held, the maximum that can be held by the promoter, the law should keep changing on the market capitalization. When it becomes 5 lakh crore market capitalization, you should bring it down to 55%.
So what you're saying sounds very similar to what RBI said to the banks. Promoters should not hold too much. Or one shareholder, not more than a certain percentage. The IPO structure today, in my opinion, is the problem. Telling companies that you can sell little now and more later,
Correct.
okay, is further distorting the price discovery. I mentioned DMart, but DMart is not the only company. There are dozens of companies.
Actually, once upon a time, an entrepreneur who required money did an IPO. Today, an entrepreneur who requires money goes to a private equity guy, and then he gives ESOP to his employees. So even TCS didn't need the money, but it was an exit to the employees and other investors. So similarly, any company today, the IPO, whether you call it an OFS or an IPO, it is a way of getting exit, not for the company to raise money. Company does not need the money is already there, but people want an exit. In such cases, the selling is by extremely sophisticated investors, and the buying is by the layman who still believes that there will be a pop. There may not be a pop. And secondly, this is not the only thing they control. They are also able to control whether at that market cap it will go into F&O or no. Why can't there be a compulsory F&O? If the limit, no, on listing or on a market cap. On the market cap, whether you have stock or
very
no,
interesting point you're bringing up. So
compulsory F&O if your market cap is more than 1 lakh crores or 2 lakh crores, something
yeah,
like
even
that.
25,000 you can have. What's up?
Yeah, so I'm saying, so that way you can at least increase some supply. I may get stuck in that 3-month call.
Even in what you're saying, there's a chance the retail further get gained because a guy who's
Yeah.
already owning locked in shares can go
Yeah.
and sell on listing day, and run the position for 6 months.
Yeah.
And then he can deliver his shares.
But it's still more difficult. Right now you make it more easy, we are trying to make it a little more difficult. That's all. Nothing else that you can do. If there is no floating stock, it's not a price discovery. I don't think.
By your logic, most of the IPOs today are not price discovery.
They are not price discovery. They are liquidity for the existing shareholders. They need a listing. In fact, something worse is happening in SME. You have very easy to get yourself listed. You don't need any conditions.
No, SME is an unregulated business actually.
Unregulated.
Because there is no regulator. I will not call a stock exchange as a regulator. I am sorry.
Yeah, it's not
I refuse to accept their skills in that, or their competence, or their skin in that game, or their interest alignment.
So anybody can take a small company, get it listed on one of the exchanges in the SME, and after 3 years, automatically you come on to the main exchange without a regulator having seen what you're doing, without having an independent board. That is rigged. You can take your share from 30 rupees to 100 rupees to 500 rupees. So that is happening. We're seeing it happening.
Subra, you are being very blunt. Where will it end? How will it end?
Every bull market ends in...
No, this particular thing of SME.
See, somehow our regulator decides to wake up only after retail has lost at least 50,000 crores. Maybe now we are at 49,000. So when we reach 50,000, then somebody complains, the regulator will wake up and smell the coffee.
But it's very unfortunate that the architecture of what has happened in SME, I'll just explain it once. Investors approach a company.
First, merchant bankers.
No, investors approach a company. Tell the company, give us so much shares, we'll give you money. Then tell the company, we will create share valuation for you.
Yeah.
Then investor tells the company what to do with corporate
governance,
structuring, cap table, what kind of investor
ESOP
should be there, how many shares to issue, how that shares should be controlled.
True.
And then investor tells the company when to IPO or what price to IPO, how to IPO.
True.
Then investor finds the investment banker.
Correct. Or he has his own investment banker.
He has. That's what I mean.
He finds his own investment banker.
Then investment banker finds investors for IPO.
Correct.
Investor himself also mobilizes investor for IPO. So investor plus investment banker conduct the IPO.
Correct.
Company is just a showpiece. Company is just marshaled around, told what to say. controlled every step of the time, puppeteered, schooled, taught, and you have this 20 crore IPO collecting thousands of crores. You have seen all this nonsense. So basically, the whole genesis of this exercise is an investor who wants to manipulate the valuation of a company, the cap table of a company, the shareholder profile of the company, and the market perception of the company. So it's completely a manufactured and a very operated and a very rigged structure that we see. Now, I'll flip and tell you how a large cap IPO usually happens, some big company. The company's board is convinced by the management that it makes sense to go public. Then the management goes and identifies the investment banker. Then the investment banker advises the company on what valuation should be.
True.
Company and investment banker conduct a conversation where they discover what is a marketable value for that company. And then they go to the regulator. They don't go to some stock exchange. They go to the regulator. File a red herring prospectus draft, DRHP. The regulator decides whether the company can be allowed to raise capital to the public or sell shares to the public if it's an OFS. Then the investment banker identifies anchor investors. Then they do roadshows and bring the other investor, which is the HNI and retail. So the second type is anyway still more secure than the first type. Both are IPOs,
Correct.
But they are not the same.
Yeah, the one word which you forgot in the first part is having a financial PR firm. So along with the investment, merchant banker is a financial PR who goes to influencers and says, oh, this will open it up premium, etc., etc. It is hyped up, it gets listed, and there may even be a pop.
Investor relations.
Yeah, there will even be a pop. You may come out with ₹100 price, and then you will come to 120 pop-up and say, look, I have to given you what you wanted.
In fact, how they get that pop itself is very interesting. One IR guy was telling me, sir, we did this IPO. It was at this price. On the 8th day, you got this price. Now I am bringing this IPO. This will also make the same return like that.
Correct.
He didn't talk about the company. Nothing about the management.
He doesn't know the name.
Nothing about the merit of the business. Nothing. And this guy is the IR guy.
Correct.
Who is supposed to make investors fully aware of the company. So this whole ecosystem now looks very weak to me. Structurally weak. I mean, it's very strong because they're releasing money. But structurally it looks weak. But sustainably, whether this can go on for long, I'm not able to convince
myself. In fact, I have not even seen an article of some SME listing coming out at 30 rupees or 40 rupees, going to 80, going to 400, going to 800, and then coming back to 30. Even if there are such cases, I haven't seen any journalist even picking up and doing an article on that. So the same thing will continue. I'm still saying the party is continuing, the music is being played. When the music stops, we will all see we have some shit on our hand. So whether we have 1% shit or 90% shit,
that depends upon your portfolio.
Depends on your portfolio, how much you have played and how much of FOMO you have. If some shit I see high price, I don't feel guilty because it's not my area. I will not go into it. I know the promoter. I know the company is not growing or the books are not happy. I'm not happy with the books. I'm not happy with the board of directors. I'll stay away. I just don't need that extra money to be made. I'd rather still make my money in my old stories.
That's a very interesting point you made, that safety and security is as much importance in making returns.
In fact, today if the market is priced at this rate, expecting to get 8-9%, you should be very happy. Because you have already made your 24-25% in the last few years. You have got your money upfront. I would look at my portfolio in January 2025 and I say that in January 2026, if I can be exactly where I am, I'll be happy.
That's an interesting point on which we are going to close this video. Subra says that even if he retains what he already has next year, that's a good thing. And we are going to continue talking. We've just begun. Hang in and watch the entire series of videos. Talking Straight with Subramanyam.